Hello and welcome to your video for per unit and variance analysis of income statements. So let's start with the per unit analysis. A per unit analysis is when we take every line from an income statement and we break it down by units sold. So we break it down so that for food and beverage, we can see on a per cover basis how we're doing for each line, and for the rooms department it's on a per room night basis. Okay, so really what it does is it provides your average daily rate for hotels, okay, or average check for restaurants per cover. Okay. It also gives us the average expense per cover for each line item. All we really have to do here is simply divide all line items by the number of rooms sold, or in a restaurant case by the number of covers in that period. Okay. If you were to really want to look at lunch revenues versus dinner revenues, we want to make sure that we're using the right number of covers for each one. So let's say we wanted to compare how our average check was for lunch and how our average check was for dinner. Well, we would probably want to make sure that we don't use our total covers. We'd want to use lunch revenues divided by lunch covers and dinner revenues divided by dinner covers. So that's what we'd want to do. What it's going to do is it's going to give us a different outlook and a different type of analysis. We're going to really be able to dive a bit deeper into the analysis so that we can see what's going on. So in this example, we're going to use a restaurant. So the covers would be, in 2016, I served 500 people. In 2017, I served 600 people, sorry. So 600 covers. Those are how many guests. Now, all the per cover calculation really is let's say the $17.75. All I would have done is divided my total revenues for 2016 by the 500 covers that were served. So $17.75 would be the average check, but it's the average amount per cover. If I wanted to further break that down to see how much of it was related to food and how much by beverage, I would just divide my food revenues by the number of covers, and that would give me an average for food revenue per cover. Same thing for beverage. So we would do that for every single line. And before we even do that, it looks like we're doing great, right? We've gone up in revenue and we've gone up in operating income. So let's keep that in mind as we move forward. It looks good so far. So $17.75 in 2016 was my per cover, and I was making $1.03 of income, operating income per guest. Okay. If we look at 2017, well, we went up. We served more people. That should be good, right? We also made more money. So we actually have an average per cover amount of $18.65. And now what we can start to do is look at, well, we've got a 90-cent increase. We're pretty sure, yeah, if we do the math, we'll do it in a second. Where did that increase come from? Did it come mostly from food or mostly from beverage? Well, if you take a look, just taking a look quickly, we went up 75 cents in food per cover. So for each guest, we brought up our price, how much we're collecting from people, by 75 cents. That's great. And then 15 cents for beverage, so that's good too. Now, if you take a look and compare my per cover for my costs, it looks like most of my costs went up. Remember, if revenues go up, I'm happy. If expenses go up, I'm not as happy. If we take a look all the way down here, we've got 94 cents per customer that's coming in is going to my income, but I had more income last year. So all of a sudden, this amount down here that looked so good, I've broken it down by a per cover basis, and I'm actually going down per person. I'm not as happy anymore. So all we're really doing when we're doing a per unit analysis, a per cover analysis, is we're doing the absolute and relative change again. Okay? So what we would have done for a comparative analysis, but instead of using our totals for each line, we're going to use our per cover for each line for the absolute difference. So in this case, we would start with our covers first. So we'd go our current year, 2017, minus last year, or whatever accounting period we're looking at. So 600 minus 500, absolute, yeah, we're positive 100. We went up by 100 covers. That's a 20% increase in covers. That's awesome. I'd be very happy with that. Then I would do my absolute change. So my $14.25 for food revenues for this current period minus last year's per cover for food revenues. So I'm up 75 cents, which is a 5.56% increase. We're still using the relative calculation where we go our absolute change divided by the previous year. Okay, so the previous period we're looking at. So absolute change divided by previous or last year, whatever you want to call it, previous period in this case, would give us the 5.56% increase. So of this 90 cents that I'm making more, 75 cents of it is coming from food. So I went up by 5.56% in food, 3.53% in liquor as far as my per cover basis. So this is good. I'm happy. If I go down though, here's where my costs went up by double-digit percentages. So per cover, I went 80 cents more for food costs, 10 cents more for beverage costs, 19 cents more. That's only a 1.73% increase. I'm not as concerned. But overall, my cost per cover is $1.08 more per cover. That's almost a 7% increase. Which is going to show up down here. Now my non-controllable costs, can I really do anything about this? I don't have any control over them. The only reason why it's down is because I serve more people. Okay, if you take a look, I actually have more non-controllable costs, but because I serve more people, I've got less costs. We don't have too much control over that, so I might not pay as close attention. This is where I'd be very concerned. I'm down 9 cents on a per cover basis. So I served more people, and sure I have more operating income, but I've got a lot of money out there that I should have been making. And most of it's because my costs went up. I went up in revenue per customer, but I went up in costs by even more. So I'm actually making less money at the end of the day. If I didn't have this many people coming in the door and I kept my costs around the same, I wouldn't have made money. I would have actually gotten below this amount. Okay? So what I would do, and I'll bring over out of presentation mode, just like we would do in our comparative and common size analysis, we would start to do some highlighting. So right away, I'd want to highlight that into green. I'd be very happy with the fact that I'm up 90 cents per cover. That's a 5% increase per cover that I'm making more. That's awesome. For my food costs and my beverage costs, that's double digit. I'd be quite concerned about that, so I would probably shade that in red and highlight that because I need to look into it a bit more. Overall, per cover, out of the costs that I control, I'm spending more, which means I'm not controlling my costs good enough. If I had more revenue, I should have stayed around the same cost per customer. This is going up by way too much, so I need to be very careful. Sorry. And then lastly, down here, my cost per customer, sorry, shading. Well, we'll just leave it at that. That's a negative. Okay, so my 9 cents less per customer that I'm making at the end of the day, I went down by almost 9%. So I'm quite concerned about that. So in this example, not only did I serve more covers, but I made more per cover. So I should actually be making more in my income if I would have controlled my costs better. We can kind of see that. But what we can do now is we can actually move forward with a variance analysis. In order to move forward with the variance analysis, we need to first complete our per unit per cover analysis. Okay, so let's go back to presentation mode. And now let's go towards a variance analysis. So again, we can see that things are going well in revenues. They're not going as well in controllable costs. And overall, we're down as far as our per cover amount. So what we want to do now is we want to evaluate where this change is coming from. Are we making 90 cents more per cover because we served more people? Or is it because we went up in the average price per guest? How much of it accounts for what? So our variance analysis will help us with that. This can be done for one line item or for a grouping of line items. A grouping would be the subtotals that we have. Okay. It's typically done to account for key revenue and expense changes between two periods. So we want to look at some key lines here. It's not going to be something like non-controllable expenses. We may not look at as much. Revenue we would definitely look at. Costs, we might look more at our variable costs that we have a bit more control over. Each analysis must include a change in quantity and a change in price analysis. Now that's unless we're doing a cost analysis, we're going to look at a change in quantity and a change in cost. Okay, so the two calculations we need to do, the two different ones, if we're doing a revenue variance analysis, we need to first look at our change in quantity. So to complete that, we're going to go our change in number of units. So how many, remember for units, for restaurants that's a cover, for a hotel that's room nights. Okay, so change in number of units, whether it's positive or negative, times the previous average unit price. So that would be a cover per previous average cover or room night amount. Then we would find out our change in price, and that would be our change in price times our actual number of units sold. So by doing this, we can then find out of our revenue increase or decrease, how much of it came from the fact that we served more or less people, how much of it came from the fact that we increased our average cover or average daily rate. Our cost variance, we're going to look at the change in quantity analysis first. It's fairly similar, right? Change in number of units times previous average unit cost. So that's the big difference. The price would be the amount of revenue we brought in per customer. The cost is the average cost per customer, right? And then we're going to look at our change in cost analysis, which is a change in unit cost times the actual quantity. So the big difference being that we're looking at costs instead of revenue. In both cases, we're simply evaluating the line to see if the results are due to the fact that we served more, so we had more covers, or because we increased our costs by too much. So let's look at an example. We'll start with a revenue variance first. So right away, we have a change in quantity analysis. So we're going to look at our change in number of units times the previous average unit price, and then we're going to take a look at the change in price. So I have a little table for you so you understand more where these numbers are coming from when we start to build this revenue variance. So this is more visualization. You don't have to complete this. You can if you feel more comfortable with it, but it's not necessary. So if we take a look, 2016 for covers, we had 500 covers. In 2017, we had 600. So we're up 100 covers. That's good news, right? We're bringing more business in. We're happy with that. If we evaluate our average check, we had $17.75 per customer in 2016, $18.65 in 2017. Well, if we look at our difference, our absolute difference, we went up by 90 cents. Again, I'm happy. This is good stuff. And if we compare our total revenues, we went up from $8,875 to $11,190. We went up by $2,315 in total revenues. And that's what we're evaluating here is our total revenue line. We could do this only with the food line or the beverage line, but we're going to evaluate our total revenue variance. So the $2,315, this is good, but where did it come from? Is it because we just had more people, or is it because we had our average check increase? So if we take a look, the first thing we're going to do is our change in quantity variance. So it's our change in number of units, which is we increased by 100 customers, times our previous average unit price. Our previous average cover, in this case, average check, is $17.75. So of the $2,315, $1,775 is directly related to the fact that we just had more people come in. Okay. Now, if we had that many more people at the old average price, that's how much more we would have made. That's the way to look at the change in quantity. Now, the change in price is where we start to evaluate this average price here. So the change in price is the 90 cents. We went up by 90 cents per cover. Okay. And now we served 600 people in total. So we actually got $540 more in revenues due to the increase in price. Okay, so of this $2,315, $540 was due to our increased average check, and $1,775 was due to the increase in amount of people. So not only did we increase the amount because we had more covers, which is good, but we also increased our price per cover, so that's good too. So overall, I'd be very happy. The last thing to do would be to add those two together to confirm that sure enough, our quantity variance plus our price variance equals how much we actually increased our revenues by. There will be some cases where this number may be negative, this number may be positive, and then overall we increased revenues. What this does, it allows you to break it down to find out why your revenues increased or decreased. Is it more because you served more or less people, or is it because you had a higher or lower average check? Whenever you complete this, you'll start to see sometimes a bit of a difference between these two. And it's just a matter of evaluating where this revenue comes from. Is it because of quantity or is it because of price mostly? In this case, it's a combination of two, which is good news. Now we can take a look at a cost variance analysis. So in this case, we're going to do the same kind of thing where we want to take a look. Let's take a look at total controllable costs. Now, the change in quantity analysis, remember, same kind of thing, except now we're looking at costs. Okay, so let's take a look at another table that I put together. So in 2016, 500, 2017, 600, more people. So it's good, but it can also be bad for costs. The more people I serve for controllable costs, the higher my costs will be, right? Because the more food I need, because of higher revenues, the more costs it's going to be. So this could be considered bad as well. My controllable costs, so total controllable costs per guest, went up from $15.83 to $16.92. So I'd find out the difference, and I went up by $1.08 here. So this is bad, right? This should stay fairly constant. If it's a variable cost, and it should be going up at the same, closely at the same relative amount per cover than the revenues. We've gone up by $1.08 here. We shouldn't have gone up by this much. We should be pretty much the same amount. We should be able to stick. If we had more covers, we should still have about $15.83 here. So we've got way too much cost per guest there. So that's bad. It's gone up by too much. And then our total costs are $7,917 and our $10,150. So overall, our costs have gone up by $2,235 here. I'm a bit concerned. Actually, it's $2,233, sorry. Okay, so that's bad. That's bad. I'm not happy. So let's complete a change in quantity variance first. So we want our change in number of units, so our plus 100 times the previous average unit cost. So my $15.83, the only reason why you might use more decimals when you're using your calculator is because if you're using Excel and a calculator, Excel takes into account all the decimals, so you might just be a bit different rounding wise. But yeah, so we would take the increased amount of covers times the previous cost per cover. So we actually, of this $2,235, $1,583.40 is due to the fact that we serve more people. And that's okay. Remember that we are serving more people, therefore our variable costs or controllable costs should go up. They should, because, well, to make more food revenue, we need more food revenue. To make more beverage costs, we should be using more beverage revenue, sorry. We should be using more beverage costs. We should have more labor because we're busier. So it's perfectly okay in this case for the costs to go up due to the fact that I served more people. I would expect this as a manager. What I wouldn't like is the change in cost variance. And that would be our change in unit costs, or a change over time of $1.08 more per cover times 600 covers. So that would give us our $649.80. Now this is the amount that I'd be more concerned about. The fact that this went up because I served more people, that's expected, remember that. But the fact that this has gone up as well, that means that I've got a problem with controlling my costs in here somewhere. Okay? And then I would add them both up together to get 2,233 roughly, which is what I should have here. So I would be, as a manager, I would probably look at this and go, okay, my quantity went up, sure, and that represents a big amount of this, but this amount right here is where I'd be a bit concerned. Why did my costs go up? And this is where I would start to look more at my food, beverage, other controllable, and I would start to analyze where most of that amount per cover went up. Right away you can see that food cost is a big thing. So I might use a variance analysis for my food costs and take a look at what the problem is there. So that's how we would use a variance analysis. So you're either completing it on revenues, and in this case everything was good, or we're completing it for our costs, where a lot of this came from our change in costs. So we actually had more costs in dollars per customer. This will allow you to, we can visually see that our costs went up here, but we can start to take a look at what's the reason behind it. That would be why we would do such a thing. Is it because we served more people, or is it because our costs went up as far as a price goes? So change in cost is a dollar amount. At this point in this course, you should feel comfortable with various income statement layouts, first of all. So USAR, you should feel comfortable with the layout and what each line means, or each subsection means. You should also feel comfortable with the USALE departmental schedule, operating statement, and statement of income and how they work together. We should feel comfortable with the comparative analysis, so how to complete it, but also how to analyze it. So how to use that in an analysis for an income statement. Common size analysis, so how to complete it and how to use it in analysis. We also need to remember the exceptions for common size analysis, where normally we use total revenue as our 100%, our common number, but in USAR and any food and beverage USALE departmental schedule, we have to make sure that we go back and we use our food revenue and food expenses. So we match up the revenues that were created directly with those expenses. We want to feel comfortable with analyzing common size costs as they relate to industry averages for either restaurants or hotel. So you should feel comfortable with some key industry averages. Per unit analysis, after this, we should feel comfortable with how to complete it. So we're just taking each line, dividing it by the per unit, so per cover or per room night. And then we want to perform a comparative analysis using our per cover or per room night numbers. And then lastly, a variance analysis. So how to complete both revenue and cost variance analysis for any given income statement line to find out why we got more revenue, less revenue, more costs, less costs. Where did it come from? Is it a change in quantity, or is it a change in price or cost? Okay. If you have any questions about this, do not hesitate to contact me. You've already learned so much in this course. Keep up the great work.